The recent failure of Silicon Valley Bank is bringing back a flood of bitter memories when the nation's financial system imploded during the Great Recession 15 years ago. Is this a cautionary tale of what to expect in the near future? Well, let's welcome Mark Witte, professor of economics at the College of Charleston. Great to have you with us.
Thank you so much.
Okay, so is the Silicon Valley Bank closure a bellwether of another banking crisis down the road?
It's unlikely. The good news is that Silicon Valley Bank was very different from other banks. 90% of their deposits were uninsured by the FDIC. And almost all of their depositors were either venture capitalists, tech companies, or employees of those tech companies and venture capitalists. So they had very few depositors, and those that they did have were large depositors. And so when those individuals started calling each other, started contacting each other about taking money out of the bank, they had something like $42 billion of withdrawals in a single day. And that's roughly 20% of the size of the bank. So very rarely do banks keep 20% of their assets in cash ready to go at any point in time.
And if the name gives it away, though, Silicon Valley Bank, they invested largely in tech and in startups.
So yeah, a lot of their depositors were tech, and a lot of what they were buying in terms of lending money out is, well, they weren't lending money out. They were buying long-term treasury bonds. And as interest rates went up, those long-term treasury bonds went down in value. And so they were in a position where if they were able to hold those 10-year bonds until maturity, sure, they probably could have paid their depositors back. But the problem is those depositors wanted their money on one day. They didn't want to wait 10 years for it.
Which you can understand why, of course.
Yes.
But President Biden, he wanted to assure those depositors that they were going to get every cent back that they had put into the bank. But the difference, he said, is that those investors are not going to get the bailout that we saw in 2008.
So yes,
so who's paying for it? How are they getting their money?
So the shareholders are going to be wiped out of the bank, but the depositors are going to be made whole. That includes depositors who may have had multi-millions of dollars with this bank. Now that's rare. The FDIC typically insures deposits only up to $250,000.
Right.
Now, because they only insure up to $250,000, oftentimes the FDIC tries to sell the bank, the bad bank, off to another bank. But there were no buyers on Sunday. They put it up for auction and nobody wanted to touch Silicon Valley Bank. No other banks were interested, including banks that we believe are very well capitalized, that have a lot of cash on hand.
But in fact, their stocks went down tremendously.
Indeed, because there was fear of contagion. There was fear that other banks would be very similar. And in fact, a Signature Bank was also relatively similar. Same condition. 90% of their deposits were over $250,000. 90% were uninsured. And so the depositors were afraid that if the bank did close, that they wouldn't be made whole, they wouldn't get every single dollar back. And yes, the way FDIC insurance is written out, they would only get a percentage back, maybe only 90 cents on the dollar.
Okay. But you say this is not necessarily a bellwether of things to come down the road, even though we're hearing a lot about a recession and impending recession. But I want to switch gears and talk about the Federal Reserve and interest rate hikes. So we have seen hike after hike after hike. They're trying to slow the economy down. What do you think is going to come of all of this?
So they're very likely to raise interest rates in the future. They may not raise interest rates necessarily the very next time they meet, but it's likely that those interest rate increases are going to continue. Recently we had the new inflation report from CPI, and we saw a 0.5% increase in inflation month over month. Now that brings the average down because it was very bad last year. But 0.5% month over month is still a very high inflation rate. That's still a 6% inflation rate. And so as far as the Federal Reserve is concerned, that's too high of an inflation rate. And so their bias is going to be to continue to raise interest rates in the future.
But the job market is doing so well. So how do we get on that even keel of balance in our economy?
And therein lies part of the issue. If the job market is doing really well, then the Federal Reserve will say, well, we can continue to raise interest rates because we're not really causing a problem with employment and unemployment. It's not really harming the economy overall. So we might as well continue to raise interest rates and try and reduce inflation.
So we've got another rate raise coming up. What are we thinking is going to happen? If you had a crystal ball.
If I had to guess, it would either be a pause because they want to get their hands around what's going on in the banking industry, or a 0.25% increase, which is lower than the 0.5% that we thought was going to occur before Silicon Valley Bank.
And with just 30 seconds left, disinflation versus inflation?
So disinflation is a reduction in the rate of inflation. That doesn't mean prices go down, it means prices increase more slowly.
All right, more slowly. All right, well, I want to thank you so much. You got to come back, talk more about this, Professor Witte. Thank you so much. We are back in 2 minutes.